Hi, accounting students. Today our lesson is the ledger. In this lesson, we are going to learn about what the ledger is, how it works, and how we make entries to it. So the learning goals then are to understand the parts and purpose of a ledger account and to be able to correctly use the procedures related to the ledger account. We will know we are successful when we can explain what a ledger is, how it is used, and why, and when we can accurately post a variety of entries to different ledger accounts. So just kind of recapping what we've learned so far. So at the beginning of the semester, we learned about the balance sheet so we can understand how a business looks from a point of view of dollars and cents. We then learned about transactions and how to post those transactions to T accounts, which we then use the balances from those T accounts to create a balance sheet. So, which to that point was a pretty full picture of the process. The next thing we did is we learned about the journal. And so we kind of inserted that step in between transactions and T accounts. So we learned how to look at a transaction and then convert that to a journal entry. The next step would have been to post those journal entries to T accounts. But instead of doing that, we are learning about the ledger. So we are building on the two steps that we've been working on, which is transactions, or which are transactions, and journal entries. And now, instead of posting those to T accounts, we're going to learn about the ledger and how we post journal entries to the ledger. So by definition, a general ledger is a book or file containing all the accounts of a business. As we are going to learn later, there are different journals and there are different ledgers, so different purposes, different kinds of accounts with different purposes. The ledger in general, or the ledger book, replaces the process of using T accounts. The general ledger accounts altogether represent the complete financial position of the business. So in the same way that we use the final balances of T accounts to create a balance sheet, we would do the same thing with ledger accounts, which we're going to see in a couple of lessons. Posting then is the process of transferring an accounting entry from a journal page to a ledger account. I've referred to putting transactions in T accounts as posting in the past. We're just continuing on with that same language. It's exactly the same thing, just a different format. What we are going to add, though, that's new is this idea of cross-referencing. In your journal pages, on your journal pages, there has been a column called PR, posting reference, which we've been ignoring to date. In this lesson, we're going to learn how that works, and what it's used for, and why. The next thing we're going to learn about is this idea of forwarding. In the same way that we run out of space at the bottom of a journal page and have to start at the top of a new page, the same thing happens with a ledger account. At some point after we've put in enough entries into a ledger, we're going to run out of space. And so if we have an existing balance at the bottom of a page, we need to carry that forward onto a new page. So we're going to learn about that. Now, in the general ledger, there are only two times that we write anything in the particulars or the explanation box, which we're going to see. When it's an opening entry or when we have forwarded a balance from a previous card or sheet, ledger sheet. So those are the only two times that we write anything in there. So in the way that we are always writing explanations or whatever in the on the journal page, we almost never do it on the ledger accounts. So how does a general ledger card or account work? Well, essentially, it's like keeping a running total. Suppose you kept your extra money in a coffee can in your bedroom. When you got cash from people, you would put it in there, and when you needed a little bit of extra spending money, you would take it out. The problem you might have, though, is keeping track of how much money was actually in the can at a given time. So you might want to set up some kind of a paper record to keep track, and it might look like this. So assuming we started out with a zero balance, you might get some birthday money. from maybe your parents or grandparents or family or whatever. And since we are having an increase in that, we might put a plus sign. And so then, again, assuming we had a zero balance to begin with, and this is the first money into our can, our total then would be, our balance would then be $50. 0 plus 50 is 50. So maybe a few days go by and you get your weekly allowance from your parents. So maybe if they're feeling generous and they give you $20, maybe you don't consider that very generous, but anyway. And so I have an existing balance of $50. I have an allowance that I'm adding into it. So I would now have $70. Let's suppose that you wanted to go out and buy an iTunes card. And so we would enter that in. In this case, though, it would be a minus. So we would indicate that. And now our new balance, we had an existing balance of $70. We've taken 25 out. We would then have a new balance of $45. Let's say then that maybe your brother owed you some money and he paid you back. So I might put in a little bit of note just to keep track. Let's say that it was for a whopping $10. Hey, every little bit helps. So then we would understand that our new balance is $55. And then let's say that the latest version of Call of Duty, Black Ops, whatever you're interested in, has come out. And let's say we've only got $55 in our accounts. We're not buying a new game, but maybe we got found a used version of it. So we go out, buy an Xbox game. Let's say that it is for $40. So we would put in our minus 40, and that would leave us with a balance of $15. So essentially, this is what a ledger account does. It's a running total. It keeps track of each of the individual entries that relate just to that account and the amounts in and out, and with a running total. Now, if you were thinking like an accountant, it might look a little bit different. And when we see this, it will start to make a lot more sense. So for one thing, having pluses and minuses in the same column is kind of messy. So we will kind of want to get rid of that. So for right off the bat, it might look a little bit like this. And when we see it this way now, it's going to start to make sense in kind of an accounting context. So if we have money in, we would, and remembering this is money, so this would be the equivalent of like our bank account and for our businesses, all of these would equate to debits. By the same token, the amounts of money that we had paid out, they would be the equivalent of credits. And then we have to have our final balance. And so really the process isn't much different. We're just putting a little bit of accounting language around it. Now, this is a ledger card that looks very similar to the ones we will be using. And so here we have our account names. So these are accounts receivable or payable because they're people names, but it could be bank account, it could be supplies. We have the account number in the top right-hand corner. We have a date column, a particulars column. Again, this is from a different kind of accounting system, so they actually put figures in there, which we'll learn about. This is the reference, so we're going to talk about how that works with the posting reference on the journal entry. And then we have debit and credit columns. The only difference that we're going to see is that there's actually going to be a column in here between the credit and the balance, which is going to be the balance indicator. We also have to show not only is the balance $240, but is it a debit or a credit balance. So we're going to see how that works. But this is roughly what a ledger account looks like. All right, so I'm going to just give a very quick overview of the steps in the posting process, because in the guided practice video, I'm going to show you how to actually do that. There's something else that's much more important that I want to spend a little bit more time on. So basically what you're going to do is you're going to start from the left and just work your way across to the right. It's very simple. So you have the date process, which is going to follow the same as what we use for a journal. So you put the year in at the top on the first line. You put in the month only the first time that you need it. Every entry that follows that is in the same month, you're going to leave with no month. It's just going to be the day. Usually you're going to skip this column unless it's an opening entry or a balance forward. You're going to, in this column, you're going to record the journal and the page number from the journal from where the transaction came from. So SJ tells me that this came from the sales journal and it came from page 1. For most of our work in the near future, you are always going to have GJ for general journal and then whatever page number in the top right-hand corner. Then you're going to list either the debit amount or the credit amount. You're going to indicate the balance, which we're going to talk about in a minute. And then once you figure out what the balance is, you're going to go back to the left one column and indicate the balance indicator. So let's talk about that, the balance indicator. Oh, and then the last step, sorry, very important. So then what you're going to do is you're going to take this account number here and you're going to go back to the journal page where this, so for instance, this last entry for 190 that came from the sales journal, you're going to go back to that entry, and in the posting reference column on the journal, you're going to put in the account number. So it's kind of like a little tick mark to show that you're done the work. All right, so let's talk very briefly about determining the balance indicator of an account. Overall, it's 3 simple steps. First, you figure out if you're going to add or subtract your amounts. You do the actual math, and then the trickiest part is figuring out the new balance indicator. So to figure out which math function you're using, are you adding or subtracting? It's a very simple rule or process. You compare the debit or credit indicator on the transaction to that of the account balance. So going back up here, if I have a debit balance and a debit entry, or up here if I had a credit balance and a debit entry, that's what I'm comparing. So the existing balance to the new entry. The rule is very simple. If they are the same, you're going to add. If they are different, so if it's a debit and a credit or a credit and a debit, you're going to subtract. Then you do the actual math. You add or subtract the 2 numbers according to what you decided in step 1. So if you have 2 debits, you're going to add them. 2 credits, you're going to add them. Or if they're opposite, you're going to subtract them. Now, in scenario 1, if you're adding, the indicator will always be what it was on the account balance to begin with. So if you have a debit and you're adding more debit, the new balance indicator is still going to be a debit. Same with credit. In scenario 2, if you're subtracting, because the two numbers are opposite, remember, when you're doing the math, you always start with the account balance and subtract or add or subtract off the amount of the entry. You have to compare the value of the balance to the value of the transaction. If the balance is bigger, the balance indicator is going to be the same. So, and then there's an example down below. If the transaction amount is bigger than the balance indicator, then the balance indicator is going to change. And this is probably an indication that you've got an exceptional balance. So for example, if you had a debit balance on your bank account for $100 and you had a credit transaction for $150, so your credit is bigger than the debit balance, then you're going to have a new credit indicator on the account balance as credit. So a final note on ledger accounts, since these replace T accounts, when we go to create our trial balance, balance sheet, or income statement, the process is going to work exactly the same, except that instead of taking the final account balances from your T accounts, you're going to be taking them from the ledger account instead. This concludes the theory part of ledger accounts. Please now move on to the guided practice portion.